Welcome to part 2 of our Finance Fundamentals educational presentation. Now that we've covered the big picture, let's take a closer look at the money coming in, which we categorize as incoming funds. We'll break down incoming funds into 3 types: regular assessment income, which are monthly HOA fees; special assessment income, which are additional fees for specific projects or unexpected expenses; and non-assessment income, which includes things like move-in fees and late payment penalties. Let's look at where incoming funds fit into the overall flow of money in our association. As we can see, they are the starting point. The money coming into the association accounts from all owners. From there, the money flows out to cover various expenses, which we'll discuss in more detail later. As this video series progresses, we will sometimes take a moment to define certain terminology to make sure we're on the same page with what we're talking about. Our first definition is for assessment. As you may remember from part 1 of this series, an assessment is a fee or charge that homeowners pay to cover the costs of maintaining common areas, amenities, and services within the community, which serves as the backbone of the community finances. Let's focus on regular assessments for a moment. These are the monthly fees that each homeowner pays, and they are the primary source of income for running and maintaining our property. The amount of assessments we as owners pay is based on the principle of proportionality, which means each unit's fee is based on that unit's percentage ownership of the entire association. This is calculated based on the unit's square footage and its floor level. Generally speaking, larger units have more ownership than smaller units, and units on higher floors have more ownership than units on lower floors. A common question that comes up is, why do regular assessments increase each year? This is due to several underlying reasons, all aimed at ensuring the financial health and sustainability of the community. Under the Illinois Condominium Property Act, the HOA Board of Directors has a legal responsibility to ensure the financial health of the condo community. This means the board is legally obligated to perform their fiduciary duty to raise assessments if it is in the best interest of the financial health of the property, even if unit owners don't want an increase. There are many factors the board considers when determining assessment amounts. Internally, the board reviews financial statements, the annual budget, and historical trends of expenses and income. They also take into account any specific requests or concerns raised by residents. The board also has to factor in financial obligations to external entities, such as the changes in utility rates or insurance premiums, and also the multiple companies with whom our association has vendor contracts in order to keep our building running smoothly. Economic factors also play a role in determining regular assessments, particularly market trends due to inflation and cost of living increases. The board also consults with professional advisors like the association's accountant, attorney, and reserve advisor to get their expert opinions. It's a complex process, with a goal to ensure that our association has sufficient funds to cover expenses and maintain the community. Another question that often arises is how our monthly assessments and amenities compare to another building. While it might be tempting to make one-to-one direct comparisons, it can be misleading. It's important to consider the broader context, such as the building's age, reserve fund health, management efficiency, and specific community needs. A building with more amenities and lower fees might be underfunding their reserves or have raised a special assessment that isn't reflected in their regular fees. To illustrate this point, let's use a personal finance analogy. Imagine one of your neighbors has a brand new car. It might seem like they're in a better financial position than you if you have an older car that doesn't have all the bells and whistles like your neighbor's car. However, that neighbor with the new car might be carrying a lot of debt to afford those things, while you have been saving and investing your money wisely. It's the same with condo buildings. What matters most is the overall financial health, not just the visible amenities or the monthly fee amount. In addition to regular assessments, there are times when there might be a special assessment. This is an extra fee paid by homeowners for expenses not covered by regular monthly assessments. Special assessments can cover expenses such as emergency repairs, major maintenance projects, capital improvements, legal or insurance claims, and required expenses for unanticipated regulatory compliance. While nobody likes paying extra fees, sometimes they're necessary to keep our community in good shape. Finally, The third and final source of incoming funds covered in this series is non-assessment income, which are fees and fines paid by homeowners based on community rules and regulations. Some examples of sources of non-assessment income are moving fees, in-unit maintenance requests, income from things like storage and laundry room fees, late assessment payment fees, and fines for rule violations. This money supplements the regular assessments and helps cover the costs of maintaining the community. However, it's important to note that this is a much smaller portion of the overall association income compared to the regular assessments. That's it for part 2 of this series. Be sure to check out part 3, where we'll dive into outgoing funds.